Again, thanks for joining us. More importantly, thanks for being our clients. We can't tell you how much we appreciate all that you do with us. I'll do a couple things here. I'll update you on a couple things going on at the company, and I will keep you posted on where our general thought process is. Your company is open. We are all 85 of us are hard at work, although primarily we're not in the offices. If you want to get a hold of us, all you have to do is call us or email us, and you will be hooked up directly with the folks that you're used to working with. Out of abundance of caution, we're all primarily working from home these days and have the technology to do that. So thanks for your patience. But please, if you don't get a response quickly, just let us know and we'll get that done for you. This is a trying time for everybody. What we've found is that our clients are the best clients in the business. Keep in mind, we're a 107-year-old trust company, and we just crossed, before this started, $5 billion. We have clients in 39 states, so we're well prepared to deal with this. We have been through many, many of these things in 107 years. We think there's opportunity here. Clearly there's a level of anxiety here with watching your numbers. If you've looked at your numbers, it's a little scary what they've done. We've seen this before. If you go back to 08, 09, we've seen a scenario where the losses were more catastrophic than what they are right now. Again, a completely different situation. We have had clients for some time looking for opportunities to adjust portfolios, to take various kinds of trades for tax benefit, tax purposes. But when the market was screaming along, it was almost impossible. Here's your opportunity. This downdraft that we have is absolutely filled with opportunity for people. You might say it's a good time to market time. Well, we saw this week market timing is pretty difficult. Who would have predicted we would have had the greatest up day in history? So let's take advantage of these opportunities that we have. Let's make some adjustments, and over time, we're confident we'll be fine. If you're in retirement mode, you didn't plan to spend all your money in the next 60 days. You'll be fine after this market comes back and makes its adjustments. The economy was healthy before we started this, and it will get healthy again. So please be patient. Again, I think I will address the general tone of our clients is everybody understands, nobody's blaming anybody. And again, I think we're encouraging people to look for opportunities that will benefit them in the long run. I'm going to go ahead and turn this over. Randy and Jan are going to provide the presentation here. Some of you sent questions in that they will answer before we're done today. We expect to be done with this about 3:30. If it's well received, I would suggest to you that we'll do this on a more regular basis if it's useful to you, and we have that kind of feedback. So if you enjoy what's happening here and you would like us to continue to do it, just drop somebody an email and let them know, and we'll get these rescheduled. So, Randy, are you ready to go?
Thank you, Kent, for opening up. I want to start with a little bit of an intro as well on what we're going to cover. But first of all, I hope you are all healthy and dealing well with the abundance of caution in this new world that we find ourselves in. As Kent mentioned, the markets have been challenging, and that's about as polite as I can be about it. Although it's been an unpleasant time, we do feel it's very important to open up our lines of communications. So I hope you've noticed the increase in communication. We've either by email or we've been doing many things on social media. And this is just another example today of our efforts to try to reach as many of you as we can. Today we plan to cover a few things. As you know, it's a relatively short period of time, but we want to share our information, our thoughts and information about the virus, and how it might affect economic conditions going forward. And then also take a longer term view, longer term market conditions to help put some perspective on times like these and how to deal with them. But most of all, our message today is that we are here to help. We will continue to monitor the situation closely and see how it unfolds. And we will continue to position portfolios prudently and opportunistically going forward. With that said, we're gonna start with the bad news first. And Jan will start with his thoughts on the coronavirus itself. As many of you know, if you've heard Jan and I speak or have seen us present together, he often takes the tougher subjects first, so that's what we're going to start with. I'll turn it over to you, Jan.
Thank you, Randy. And, you know, I have to say, of all the things that I've analyzed in my career, I never anticipated that coronavirus data sets would be among them. But we are where we are, and what I want to do over the next 10 minutes or so is to share with all of you, what we know so far about the virus, on the impact it has had on the economy, and also the response that we have seen from the authorities. So as Randy said, we'll start with the bad news. As you look at the world map here, you can tell that the coronavirus is everywhere. Over the last few weeks, it has migrated from Asia to Europe to North America. As of this morning, the total number of reported cases worldwide exceeded 550,000. As I was just looking at the last count just before we started this webinar, we're now up to 585,000 worldwide. So it took us about 10 days to go from 100,000 cases to 200 cases globally. Only 4 days to go from 200 to 300. 3 days to go from 300 to 400. And only 2 days to go from 400,000 cases to where we are today. On the next slide, you'll see that China was the first country hit with the virus. What you can tell is that China was the first country hit with the virus. It's the orange line on the chart here. China was also the first country to largely contain the virus through very aggressive quarantine measures. Interestingly, if you look at countries like South Korea, Japan, Singapore, and Hong Kong, I think it's pretty clear that these countries learned some valuable lessons from previous viral outbreaks like SARS in 2003 or MERS in 2013. These Asian countries aggressively tested people, traced and tracked infected people, and imposed severe quarantines early. And I think the word early is very important here. And as a result of that, they've managed the outbreak better than anybody else. Europe and the US, we know, were initially dismissive about the outbreak and reacted late. In the US today, unfortunately, we now have the highest number of reported cases in the world. Over 96,000 reported cases as of just a few minutes ago in the US. On the next slide, now you'll see that in the US, the hotspots have been the densely populated areas like New York State, which is currently handling just under 50% of all cases in the US. Most people are now following the large gathering bans and social distancing measures. But as of yesterday, we had a total of 20 states, the ones in yellow on the chart here, that had instructed people to stay home with non-essential businesses closed. I think it's very important to realize that in the US, we are operating under a highly decentralized structure. So containment measures have been driven by state authorities, not the federal government. These containment measures have generally not been coordinated together by states. Generally speaking, state governments have acted to flatten the curve in order to lessen the impact on their healthcare system. So as we move forward here, we question the effectiveness of a patchwork approach here. Because if you think about it, as people are still free to travel from one state to another, aggressive preventive measures taken by one state can quickly be undermined by more relaxed rules taken by another state. And at this point, there are no domestic travel restrictions for anyone. So if not handled properly, this could become an issue down the road as we're trying to reopen our economy. Now, the next two slides should not surprise anyone. Now, if you're older and or have pre-existing conditions, you have to take this seriously. Data continues to show that people over the age of 60, especially the ones with pre-existing conditions, are the most vulnerable. As you get older, your immune system gets less and less effective, and therefore you're more and more susceptible of getting the virus with consequences that follow from it. On the bright side, if we look on the next slide, of all the people that have died from the coronavirus so far, only 1% did not have any pre-existing conditions. Said otherwise, 99% of the people who have died had at least one pre-existing condition. On the next slide, we're going to look at the bright side. At this point, there are no proven vaccine, treatment, or cure against the coronavirus, but we believe that there are potential solutions down the road. And you can be assured that the medical community is working 24/7 to resolve this. The first two potential solutions that are listed here, herd immunity and vaccine, are great, but they will take some time. The first one, herd immunity, occurs when a high percentage of the population develops immunity, bringing the transmission rate below 1. This is one way to get rid of the virus, but it takes time. A vaccine would prevent people from getting the virus in the first place, but we are told that this is probably 12 months away at best. So herd immunity or a vaccine are great long-term solutions, but they won't help short-term. And we know we need short-term help here to restart our economies. Shorter term, we believe the solution may be one or a combination of treatments. So treatments can reduce the severity of the disease and or the time in which a patient requires hospitalization. As of now, there are dozens and dozens of already approved drugs currently being tested to evaluate their efficacy against the coronavirus. The two that are mentioned on the slide here are the two that have been widely discussed in the press. Hydroxychloroquine plus Z-Pak, which is a malaria drug plus antibiotic combo, and remdesivir, which is a drug in phase 3 trials, which result expected in early April. So both are currently being used on patients as we speak, and data is currently being accumulated to evaluate the outcomes. Again, I want to be clear that at this point, there are no proven vaccine, treatment, or cure against the coronavirus, so it's important not to create false hope, but the race is on. And we believe that once we have an effective treatment, that will go a very long way in allowing our economies to return to some sort of normalcy. So we're paying very close attention to developments on that front. On a lighter note, this is a picture taken at a CVS pharmacy in Racine, Wisconsin, a few days ago. And I titled the slide, "Is this going to be the new normal?" Now, we heard from the Trump administration earlier this week that by Easter, they would like the economy to mostly be back on track. We'll have to see if that happens. We certainly expect in the next several days and weeks here that we're going to have a debate between saving lives and saving the economy. Now, there was a report from the Wall Street Journal yesterday indicating that the administration is looking at categorizing counties in the United States as high risk, medium risk, or low risk to provide local officials with new tailored containment recommendations. So it will be very interesting to see what comes out of that and what state governors in particular do about all that. At one point or another, we're going to have to find ways to protect the vulnerable while allowing others to slowly but safely go back to their normal lives. On the next slide, we're showing our estimate at this point in time of what the impact may be on earnings. What we know is that not all sectors of the economy will be affected the same. But generally speaking, we believe the impact will be severe, but concentrated, we hope, in the second quarter. So for now, we've penciled in a 30% decline in 2020 earnings, with most of the pain, again, being felt in the second quarter. Just as a reference, earnings declined by about 40% in total during the 2008-2009 credit crisis. So the bottom line here is that we expect profit decline that will not be as severe as what we experienced in 2008-09, but still be material. Ultimately, we all know that the cure will have to come from the medical field. But in the meantime, I think it's very important for our governments and central banks around the world to provide some support, and we have seen that. In the US, the Federal Reserve has reacted quickly and forcefully to make sure that the financial system continues to work properly, and it is. The Fed has resurrected support programs from the 2008-09 crisis and created new ones as well. In Washington, a fiscal package was also supported by both the Senate and the House. The House actually voted on the package this morning. It includes $2 trillion worth of stimulus, which equates to about 10% of our annual GDP, and is about three times the size of the TARP program that we all remember was launched in October 2008 to stabilize the financial sector. So we are very encouraged by the actions taken by the authorities to prevent the situation from turning into something worse. We believe that these actions will not only help support the economy during these difficult times, but also help in the eventual recovery. So I will now turn it over to Randy for the second part of this webinar.
Thank you, Jan. So we're going to shift gears a little bit, and as we do that, start to think about things in longer-term basis and how longer-term investors should look at things. From that standpoint, first I want to address the idea that it's not your typical recession, and I think that's fair. As you look at this list, these are typical conditions or drivers of past recessions, and of course, something that we're dealing with today is not on this list. But I also think this brings up a good point. Each recession, each bear market is different. It feels different. It's driven by different factors. But the one similarity that all these recessions have is that we've gotten through them. And that's no exception to what we're dealing with today. We believe we'll be at a better place down the road. So it's not your typical recession, but it happens. So first of all, let's take a look at a longer term view of what volatility looks like in the market by using the S&P 500 that you see here. This is showing what type of pullbacks or contractions the markets experience and what frequency. So as you can see on the left-hand side, 5% pullbacks happen pretty often, about 3 times a year. There's some years like 2017 where we had no indication or no 5% pullback. And then there's some that have more than three times per year. About once a year, we have a 10% pullback. And actually the peak to trough on average in the last 20 years has been about 13, almost 14% on any given year. The 15% happens every 3.5 years. And then the 20 or more, which we find ourselves in today, happens about every 6.3 years. We're fortunate enough to, we've just finished the longest bull market and the longest economic expansion. And the last time we had a 20% pullback was almost 11 years ago. The return since then on the market has been 451%. I think it's easy to, as an investor, and it's a natural thought process to take a look at your portfolio and say, I should have done something, or call up TrustPoint and say, I think I need to do something, I want to do something, I have to do something. At the end of the day, as long-term investors, we don't believe you have to do anything. This is one of the examples to help explain that. What you're looking at is over the last 20 years, the average return on stocks was 5.6%. As you see moving left to right, as you take away the best days in those over 5,000 trading days, the return very quickly erodes. By just taking away the 10 best days, it drops more than a half to 2%, and taking away the 20 best days, you have a negative return. Taking as many as 50 of the best days, just under 1% of all the trading days, the return is negative 5.9%. What's even more interesting, on the best 20 days, 12 of those days happened in years with negative annual returns. So it gives an indication that it's very challenging to try to time the market and be in or out of the market on any given period. The bottom line is usually when the urge is to change is strongest, the benefit to change is the weakest. Many of the questions we receive in advance centered around this concept. As portfolio managers, we enjoy getting these questions, thinking optimistically about about the circumstances at hand. So here's an example, an illustration of the growth of $10,000 for two different investors. One's opportunistic and one is apprehensive. So the blue trend line shows an investor that started with $10,000 back in 1977. And every month that the market dropped more than 8%, that opportunistic investor added $2,000. On the flip side, the orange trend line indicates an apprehensive investor. So every month that the market dropped, the equity markets dropped 8%, they took $2,000 out of their investments and put it in 30-day treasuries. So it's pretty astounding the difference that you see from some simple moves along the way over a long period of time on what the ending balance is. The opportunistic investor, over $1.4 million, and the pessimistic or apprehensive investor, under $400,000. As investors, I think it's important to understand recessions and are going to transpire. Bear markets are going to happen. It's just part of the investment journey. So what you're looking at here is recessionary markets since the post-World War II, and also the the decrease and decline associated with each of those recessionary periods. There's a lot of variety of paths each of these take. Some are very mild, where you see in the 50s and 80s, where it's not downward, this doesn't reach a 20% decline. And then there's other, like the last two, that were nearly 50 and above 50% declines. But overall, there's been 11 time periods since post-World War II that the market has experienced a recession. The average decline of those 11 has been 30%. After 1 year from bottoming out, the average return 46%, and then much more powerful, the 5-year return after those periods, average annualized return of nearly 20%. As you can see at the bottom, we've highlighted where we're at today, right about 30%, or at worst, I should say, about 30% down. So we are at an average decline so far. It's hard to say how long this is going to last. And it's also hard to say what the returns will be, but just the last 3 days is a good indication of the potential of a rebound. As Ken said earlier, it's been pretty impressive. The last 3 days in a row are the best 3 days in the market since 1931. So again, giving you a good indication of the potential of a rebound. But again, with that said, there's a lot more that has to happen that Jan had highlighted earlier. But we will work through that thought process as this unfolds. And the other point I want to make is to remember the other side of the portfolio, the bonds. What you're looking at here is if we take all of the month returns over the last 30 years and stack them up from best to worst and took the bottom 10%, the worst 10% of the months, what did major asset classes do? It's not surprising they're somewhat listed in order of risk on the left-hand side. But it's also important to know the fixed income acts as that shock absorber and a diversifier during the turbulent markets. I think this is probably an aspect that we often find when we're having conversations the last couple of weeks with clients. You know, some have more aggressive or more heavy in equity exposure, but those that are more balanced, and you see the headlines of the market declines every night, if not more often, it doesn't mean that that's the amount that your particular account has declined. So what are we doing about it? I think it's important to give an indication of how we're thinking and what we plan to do going forward. So first of all, reevaluating the risk return exposure in the portfolio. In other words, we're looking at the recent downturn in the market as opportunities, or looking for opportunities. We need to be thoughtful and prudent, but also opportunistic. That's been mentioned a few times now. So we will do that going forward as we see things unfold, as we see things improve. We will look for those opportunities to increase equity exposure. When we went into this situation, we were underweight equities. We were more conservatively stanced. Now we're further underweight because of the market turn, but we will look to move that back up to where we feel is prudent. Tax loss harvesting is an important part of the portfolio process. We will take, during repositioning the portfolio, we will take some losses. This is a valuable strategy to offset future capital gains as we reposition our strategies. And then acceleration of transition plans. For newer clients and clients that have recently added to their portfolios, we tend to dollar cost average in. We have certain triggers that will help us determine if we should accelerate that dollar cost averaging process, and we've been doing that. Again, a very important value in the long-term investment process. So what should you be doing about it? Managing your stress. Stress impairs your ability to think. I recently read an article about the psychology of investing, the psychology of how our brain works. And in layman's terms, because I'm certainly not a psychologist, but the part of the brain that deals with fear and panic is not the smartest part of our brains. Irrationality dominates this part of the brain, and that certainly is evident in times of stress, but it's an important part. Knowing that can happen is just to manage your stress, stay calm, seek help like we're offering today. Turn out the noise. It's not different this time. It will pass. And then stay focused on long-term plan always, with no exceptions. With that said, would like to finish with just a couple closing comments. On behalf of TrustPoint, I want to thank each of you for spending some time with us today. I also want to thank all of you that have connected with a TrustPoint representative in the past weeks. I've heard about lots of good conversations. I've had many conversations with myself. So I want to thank you for giving us the opportunity to share our thoughts, address your concerns, and provide some reassurance in a not so assuring time. So at this time, we're going to end the webinar. Please feel free to call us. The discussion does not have to end here if you have other questions or concerns. If you did provide us with questions earlier, and I believe we answered most of them throughout the presentation, but we will be following up with you as well to make sure that we have all of your answers, all your questions answered. So thank you very much. I hope everybody stays healthy, and we look forward to better times ahead.